From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, May 21st. You're listening to the Macrocast. Tony Fratto in New York, John Fagan and Brendan Walsh for our Markets Policy Partners down in DC. Guys, we got Fed minutes this week. There's a Fed minutes from from a couple weeks ago, from late April. To get a little insight into what the FOMC is thinking about what they're seeing in the economy. And, the thing that struck me was that, Powell's been saying it's not only is it not time to talk about withdrawing support, it's not time to talk about talking about withdrawing support, but it seems like some other members of the FOMC seem to think it was time to talking about withdrawing some monetary support, isn't that? Yeah.
Thanks, Tony. It's not a total surprise. This is separating out interest rate hikes from tapering quantitative easing. Quantitative easing, obviously, being the asset purchase program, and they're purchasing treasuries and mortgage-backed securities. 120 billion a month is the current pace, and the speculation has really been around when is the timing of the taper, and the taper is the first step toward the glide path to eventual rate hikes. And so the taper isn't just the taper, it's also a signal on timing for rate hikes. And so hence the very sharp focus on the commentary about the taper. The Fed has been really crystal clear on its rate guidance. It's not quite so crystal clear on it's not really crystal clear at all on the tapering guidance. Substantial further progress toward the Fed's goals is the formulation that they've used. Fed officials have generally said that's sometime from now, and most of the Fed officials in recent weeks have said it's still some time from now. But there has been some growing divergences on the committee. That's totally normal. For instance, Dallas Fed President Kaplan has been one of the key proponents of beginning to perhaps in the not too distant future talking about. Now, this is kind of what was captured in the minutes. It was relatively gentle. I'll quote: "A number of participants suggested that if the economy continued to make rapid progress toward the committee's goals, it might be appropriate at some point in upcoming meetings to begin discussing a plan for adjusting the pace of asset purchases." Wow, there's a lot of bubble wrap around that.
And we also have to remember that we're reading an excerpt from a meeting that took place before the disappointing jobs number came out.
That is a key aspect, and relatively disappointing April industrial production. Yep. And
actually kind of everything across the board.
Sales.
Yeah.
So
and that's captured. So the city surprise index, they have an index. So it's how the data is coming out relative to expectations. So data can still be fine, but if the market was expecting it to be awesome, it goes down, and it actually turned negative today. So, we had huge expectations that, come everyone getting shots, that the spring and summer was going to be off to the races.
Have we overestimated it, Brendan, do you think?
I think we have, in terms of, but I think a lot of it is the supply constraints. It's just hard to get everybody back, to go from 0 to 60. Economies just don't work like that, So I don't think it's troubling, but I think it's just going to take a little longer for us to get there.
The supply constraints are real. I mean, we look at things like, so obviously, like, a lot of attention to, semiconductors, chips, lumber. Steel is not in short supply, but it is at pretty high prices right now.
Yep.
Steel is expensive, and as much as pricing is a throttle on growth, you're going to pay more for steel. And so,
and even like little things you wouldn't even think about. So if you have a boat and your engine broke and you have to buy a new engine, it's 2023 before you can get it. because people bought so many boats in 2020. There's no more boats and there's no more engines. And you don't just ramp that up,
like a boat glut. That is a boat.
Oh my God. Yeah. Hold off, because after the summer, there's going to be millions of boats on the market.
Definitely short boats, because totally the glut is coming. When people understand what maintenance costs and how little you use those things, yeah, there will be selling. As a complete aside to all of this, there's this ongoing saga of a very wealthy Gulf couple getting divorced. And the sticking point is, the wife wants this $240 million yacht, which I think is the craziest thing that someone would want the $240 million yacht in the divorce settlement. I would gladly give them the yacht and take the cash.
Well, Jeff Bezos just built a $500 million super yacht. And he also built a $250 million sister yacht. His yacht has a yacht.
like a pony, for your thoroughbred, right?
Yeah.
The new rentals on the Potomac are like $5 an hour, and they're awesome. It's really good.
Okay, so all this stuff built out and probably let a lot of us. Look, I still think we're going to have this is a ripping economy. It's going to be
totally. But the same reason that prices are going up because of supply constraints is the same reason that some of the macro data and the growth data is disappointing, because we just don't have the capacity to do things right now.
Yeah, but these things are real constraints, and they do have an impact in job creation. Yep. and it's something. There's a new item paying attention to today is the expiration. Not so much the expiration as much as it is the exhaustion of the PPP program.
Yeah.
So PPP is out of money. It's done, and there are a lot of small businesses and restaurants who still could use PPP resources for some time before their businesses are going to be able to get back to being good economic engines. Even with this economy coming back and opening up, it still takes a lot of time for these places to come online. They've essentially, we use, we could look at a lot of companies as, kind of zombie businesses who have been kept afloat by taxpayer support over this period. Eventually even zombies die if you withdraw support, and so you wonder whether it's premature or whether that's, they're going to have to.
I was at the office yesterday, and downtown is slowly reopening, and you see, the lunch places are some of them are open, but I was there at 1:00, and normally the sandwich shop in our building at 1:00 there'd be a line out the door, and there was like 4 people there. It's not their fault. People just aren't back in offices. When they are, they will have a very viable business again.
Yeah.
And the Fed basically, just to circle back to where the Fed is, all this confusion really is validating the caution that the majority of the committee, and even, let's face it, even the hawks on the committee are very, very cautious here. And this is much more about, setting the table rhetorically on a very long runway to this, to eventual normalization. But the minutes also made the point that inflation is extremely noisy, and they're sticking with their transitory characterization of price pressures, which really have been validated by the data. There's just clearly a lot of distortion in these prices. So, the markets reacted with a little bit of, slightly to the headlines, essentially, that really focused on this talking about tapering in the minutes. And I think that really speaks to the communications challenge of the Fed here. They've got so many cross currents over the summer. We agree with you, Tony. We think that we'll look back at April, it'll be a blip, right? Mm-hmm. And this economy is going to be very strong over the summer, but it's not always going to be a straight line. And there are going to be these mixed messages that come through. And for the Fed to be basically hanging back, but trying to message this delicate balance between economic optimism, transitory inflation and continued commitment to ultra accommodative policies, it's tougher messaging over the summer. There's going to be a lot of guessing games about the taper potentially being announced at the Jackson Hole symposium in late August. And our expectation is that the Fed tries to get ahead of that and message through it. Really, essentially, in the most simple of terms, there are 3 non-farm payroll reports left before the August Jackson Hole symposium. Yeah.
And John, let me ask you,
April, they've all got to be knocking it out of the park for the Fed to talk about taper at that.
And we talk about the market reactions, and so many people think that the equity market is the one that matters, where that's not really what the Fed is focused on. The rates market is really what matters, especially when it comes to Fed policy. What is the rates market pricing in right now?
So right now, if you look at futures markets, the expectation is still it was kind of like late March, early April. There was a sense that maybe the Fed would have to start hiking rates in the late 2022 kind of time frame. There was a sense that the taper might show up in the second half of the year, be announced at Jackson Hole, and start up in the third or fourth quarter. That has kind of come off the boil a little bit here. Markets have backed off and paired some of those bets. Still, they're ahead of the Fed. They're giving the Fed, far less than full credit for its median rate projections. And markets are still seeing rate hikes beginning in a series of rate hikes in 2023. But not as aggressively priced as those used to be. And so that shows that the Fed's messaging is getting through, and that the data as it's developing is validating in the minds of the markets, on the margin, what the Fed's guidance is going to be.
Yeah, I think you're right on that. And your point about, we have some intervening meetings on the calendar before we get to Jackson Hole. These guys are not interested in pulling surprises in the Grand Tetons. Actually, they're going to be in person now. There's a remote.
I don't know. I've searched that. I haven't heard.
I haven't heard either.
I don't know if it's decided yet.
Yeah, it may not be. But at any rate, neither in spirit nor physically, I don't think they're looking to surprise anybody.
Yeah, but I think that the chances of a surprise would be slightly higher if they were actually together. I think if it's remote, that there's no chance of a surprise. You're just going to keep doing what you're doing.
Yeah, and
I do think those hikes help. People talk.
Yeah, but John's point that we've got a few months of data coming at us. Yeah. We've got jobs. We'll have better measures of inflation and goods orders, and seeing if these and what shakes out with the supply chain disruptions, the continued opening on vaccines. There's a lot to learn over the next few months, but there's also a lot of opportunity for them to message in that period also. Like, they are not going to, when I say they're not going to surprise us, I don't think they're going to surprise us in Jackson Hole. I think whatever they plan to say in Jackson Hole, we're going to get some breadcrumbs, along the way in June and July.
Yeah, there's nothing special about Jackson Hole. It's just a meeting. In the past, some they have transitioned, but it's not like you have to do it because you're at Jackson Hole.
But as a communicator, someone focus on sort of communicating some of this stuff. I actually I like the idea of dropping the big idea at a conference with a bunch of smart people, smart economic people, and all the smartest economic reporters are there.
Right.
And the great,
because it's a perfect time to message it, and then all the smart people are there to answer the questions, and all the smart reporters are there to ask the questions.
Yeah, I think they go and carry the message on it that way. But I just don't think the character of this Federal Reserve group, this chairman, this board, and I think they don't have an interest in dropping surprises. I think that everything that we've seen from them over a number of years now is they try to signal far in advance. Sometimes they don't always nail it, right? I mean, sometimes you get it wrong, and sometimes they have to change direction. We've seen that happen, But their interest is to not surprise market participants. It's to signal early, to let them know their intentions. And now I think, again, I think sometimes it would serve them better to reserve the right to surprise a little bit, because sometimes surprising has an effect also in how people operate. You don't want, sometimes I think the Fed gets too interested in not surprising, and then in which case you feel like you have a one-way bet, and so that's not necessarily a healthy market if it's one-way bets. And we've seen some one-way bets here for a while. Now let's play it into their I think broader macroeconomic goals, and especially in a crisis environment where you want to assure people and let them have anchors on policy. But I don't know that is a peacetime place to be. I think you want to have sort of some equal anticipation that you have to go do your own homework and your own diligence to think that the future is going to be, and not just rely on whatever the Fed is telling you the policy stance is going to be. So what else? Anything else interesting out of that you guys saw?
I think the global central banks, just one last note, is that global central banks are not all together anymore. We are seeing some tapering, and Bank of Canada and some other central banks are beginning to pull back from the extraordinary easing. The European Central Bank has a much more forceful hawkish contingent for President Lagarde to contend with. She's held the line on that so far. The Bank of Japan has been basically as dovish as everybody has expected. The Reserve Bank of Australia has held the line on its easing and been pretty forceful about pushing back on the sovereign rate pop that we saw in sort of the February, March timeframe. Mm-hmm. But there's increasing differentiation among central banks.
Yeah, actually, yesterday I saw headlines where Draghi was making dovish comments about ECB policy, and it took me a second to remember, he's not at the ECB anymore. He's the head of Italy.
Yeah, and one of the things that is interesting on the back of this is when you see the U.S. growth, as we talked about it, it's more nuanced than maybe the expectations of just a straight up, rocket ship to the moon in terms of the recovery. But those expectations matter. And when economic data falls a little short of expectations, even if it's stronger, that has currency implications. And we've seen European growth, which was expected to be pretty tepid, lukewarm, and choppy because of the lagging vaccine rates and the lingering sort of shutdowns and restrictions. European economic growth has surprised almost, across the board to the upside for the past couple of months. And we're seeing that in renewed euro strength. And that is sort of underlined by the kind of louder hawkish undertones in quarters of the ECB. So it's a very nuanced kind of time frame, and we think that the communications challenges for central banks and the sort of implicit coordination that central banks tend to engage in gets harder and harder from here.
Do you get the sense that Europe is interested in the virtues of a stronger euro right now? Obviously that it has consequences for competitiveness there right now, but you get the sense that in fact sometimes not a sense, like some explicit goals by many in Europe of wanting to see the euro be used more for global transactions, to challenge the dollar as a reserve currency, which was not an express goal of the euro for a very long time. But I think they chafed after what happened during the Trump administration, using the dollar as a cudgel with European companies.
Yeah, I think that there's certainly maybe a greater appreciation of it. I think the broader instincts of maybe stability and a sense of kind of keeping your own house in order, which is the U.S. basically the U.S. approach to the dollar. The strong dollar policy is sort of the headline typically, but a sense that some of the things you can do internally, focusing on growth, focusing on the ability of Southern Europe to be revitalized under Italy under Draghi is it has the feeling of a potential growth story of greater unity of the European project. The pandemic has been galvanizing to that. There's been we've talked about this on the podcast before, a degree of fiscal federalism that hasn't been there, an acceptance of that, of the European project taking the next step toward integration. That's bullish for the euro and over the long period of time. So I think that it does fit into the context of this reimagined next phase of the European project, which is probably cherished by Mario Draghi and his allies more than some others. There's always a lot of diversity of opinion.
It is, but it's funny how these things sort of sneak up on you, right? But this whole the Draghi experiment in Italy it has consequences, I think, for the entire EU. And the future of the euro and the future possibilities for greater fiscal integration, and if he is successful in generating growth not just in the north but in the south in Italy, he's got an opportunity to serve as a model for for the rest of the union. So we'll see. If someone who pays attention to Italy, I guess I'll be paying extra attention to him now, but it would be good to see growth returning. I was talking to some European World Bank people yesterday in DC, and they're feeling good about the ramp up on vaccinations finally in Europe, and so we'd love to see some economic activity returning there. We need all of these engines of growth. We need them for here. Yeah. Have you guys altered your thinking on how fast growth gets? Have you had a reason to think about taking off expectations a little bit, and has the market, based on what we've learned and just seen in April?
I don't think, broadly speaking, that we've really changed our tune that much. The expectation of the recovery being, strong and sustained and really impressive, I think, is when we look back on the summer months, that's what we're going to see. But the reality is, everybody, when you think about these expectations of the rocket ship to the moon, the reality is always more nuanced. There are going to be months where you have wonkiness in the data, and consumers get tired out, or maybe there's something that's a little more structural, or at least transitory, as individuals reemerge from the pandemic and want to ease back into the kind of lives that they had in the past, rather than rushing out and doing it all at once. And it's a big social experiment, and as we've discussed with John Dick, and so I think that there's going to be, ultimately the direction and velocity will be something that we can be very happy about, but there are going to be potholes in the road.
Yeah, I think we have the capability to grow very fast. It's just I'm not sure. The labor market is confusing this time. I'm not sure exactly how quickly people will be able to fill job vacancies for a whole host of reasons. I think that's the biggest constraint holding us back.
Yeah, definitely. Every jobs non-farm payrolls report is like the biggest ever. I think this is a really interesting one, because I think, like, the mysteries of April, we need to find out what really do we think is going on, and is it confirmed, or do we have a surprise? Right.
I'm more interested in the revisions to April than necessarily what happened in May.
Me too. I think
just as interested.
I agree with you on that 100%. I'm really, really curious to see what we learn from revisions. Hey, I'm going to be doing, my best on, trying to support this economy. I was like getting on a airplane this afternoon to fly to Pittsburgh. It'll be my first time on a flight since January of 2020.
Wow.
So, I'm pretty excited about that. I'll let you know what the what the airport scene was like. You guys have flown though, I think, have you?
Yes, I flew to Florida a few months ago.
I haven't flown.
Are you flying out of LaGuardia?
Yes, I am.
Is the new one?
Yes, I am. I'm excited.
Oh, wow. You have to tell us about that next week.
I will. I'll have a full report on LaGuardia. I've been needing to go to Washington a few times over the past few weeks, and so the other day I had a chance to. I took the train to Washington from the new Moynihan.
Oh yeah, that's gorgeous, right?
Which is absolutely stunning. And for any of our listeners who made regular use of Penn Station, which was a whole,
the worst place on earth,
dark and dirty and uncomfortable and just a dungeon of a train station. The Moynihan station is the opposite of all of those things.
So is it across the street at the post office?
Literally across the street in what was the old post office, and most people don't know this, but that beautiful neoclassical structure across the street, that's what Penn Station once was.
Yeah, it used to be amazing. Yeah.
Place, so you get to see that now, and but it's open and airy, and it's clean and just really wonderful. And I used to think about just getting to Penn Station at the very last minute because I want to spend as little time there as possible. Yeah. Now I was there early because I had to do a phone call, and it was great just hanging out in Moynihan Station.
No, I mean, every time I go to Penn Station, I always think, why the tracks go underneath both these buildings? Why is this the train station and not that?
Wonder no more. Wonder no more. All right, hey, let's take a break, and we'll come back and look ahead. You're listening to the Macrocast.
Hamilton Place Strategies, HPS, is an analytical public affairs consulting firm with offices in Washington, D.C., New York, and California. HPS uses substantive analysis to understand complex topics and create public affairs tools to explain issues to target audiences and reach critical stakeholders. We achieve our clients' goals by enhancing understanding of issues, products, and companies, and ultimately improving outcomes. Learn more at hamiltonplacestrategies.com. or follow us on Twitter at HPS Insight.
All right, back on the Macrocast. Hey guys, looking ahead to next week, we have the bank CEOs are going to be testifying. There's a lot to get into, and I'm sure we'll talk about what they, how that hearing goes next week. But, one of the things that's, we've been seeing in the markets and what policymakers are grappling with is, how to treat crypto assets. We had the recent, situation where the, Colonial Pipeline paying off the ransomware attackers in cryptocurrency. Treasury came out yesterday with its tax enforcement recommendations. One of the recommendations was a real body blow to crypto, which was trying to shine light on who is moving these assets around. I think there are challenges there, but they're trying to get at this this point that we've made on this show frequently in the past, that you do whatever you want with these assets, but at the end of the day, Treasury is going to need to know that you're paying your taxes. You're not using these assets to avoid taxes, and that you're not funneling money to the bad guys. And they have strong suspicion that you're avoiding taxes, and they have pretty good evidence that you're paying off the bad guys.
Yes, that's right. Yeah. And we've been telling our clients that the regulatory regime that was under the Trump administration was very laissez-faire. It was Treasury Secretary Mnuchin was very focused on the terrorism financing angle. But the publication of bright line rules, it tended to be enforcement by basically the regulation by enforcement. They would pick out some of the worst actors or actresses in the space and enforce against them. The SEC had a fuzzy rules on characterization, and the Treasury Secretary Yellen and SEC Chief Gary Gensler are clearly going to try to rectify some of these. We expect a lot more bright line rules to follow this. This is just the tip of the iceberg. We expect certainly getting your arms around the tax reporting is always job one. Get more information in the door. As you know, Tony, from your time at Treasury and the White House, that was always like the first the first thing on the list. Get more information, and then you start formulating rules around clear tax treatment of cryptocurrencies and how investors in this asset class are going to have to treat the gains that they achieve, and the monetization of those, the realization of those gains. It's going to be a process that is part of the maturation of this asset class. Mainstreaming, you can't mainstream Bitcoin and these without some of the institutional and regulatory requirements that mainstream assets all have to follow. And we haven't even gotten into the SEC part of this, which is the investor protection piece. That is going to be, look at what Elon Musk, call it what it is. This is market manipulation, right?
No question about it.
And he's doing it on purpose, surely. And what exactly is behind it? Is it personal gain? Is it just, to stir the pot? Who the heck knows? But it's something that the regulators will want to know. And it will be something that, down the road, that kind of behavior, they will see as malign from the standpoint of retail investors in this space. And that's the kind of aspect that they're going to want to at least get their arms around and understand from a regulatory standpoint. So that it's, anti-money the malign uses, anti-money laundering, and terrorism financing, taxation, and investor protection. And those are the three, we think, the three goals that they are going to be going toward in their regulatory structure. And we don't think that the excitement in crypto markets, it's always, speculative energies are on display in the crypto market in meaningful ways. But, there are going to be some more growing pains to come.
Yeah, I won't ask, how do you price these assets? And because there always been problems of pricing them specifically in the case of Bitcoin. This is the irony to me, is that to me, the joke of a Dogecoin is actually a better managed asset than Bitcoin, because it's gonna, there's a plan to grow the quantity of Dogecoins, which is a joke, but at least there's it has some basis in reality. Bitcoin, which is we're gonna reach the end of the mining of it at great cost to the environment and energy usage. But then you have an asset that will only go, we will only see fewer Bitcoins over time, not more. And you can fractionalize it and do other stuff with it too. But it's a weird thing to try to use as a currency. It meets the best gold bugs idea of what a magic coin would be.
It doesn't respond to typical traditional macro stimuli. At least if you think it's a hedge against over, liquidity or Fed aggression in policy, or, fiscal largesse or the fiat money crash. If you look back, it doesn't seem to behave like that.
No.
And
in all kinds of wacky ways, but even if it acts the way most of the proponents would like it to ask, which is to say that they see it increasing in value over time, then it just inspires hoarding. And, the things that you hoard are not good medium of exchange. And so that makes it not a good thing to use as a currency. And it seems to be, I was going to ask you this earlier, but I still don't see, much use for a Bitcoin-like asset, except to pay off, ransomware extortionists. I'm not really sure, for anything illicit, or if you need to transfer large amounts of money in non-traceable ways. That's the only use for it. That isn't already solved by, using traditional currencies.
Well, this brings us to a very interesting point. The Fed has just released yesterday their intention to publish a white paper on a central bank digital dollar. Yeah. And the frictionless, when you talk with proponents of cryptocurrencies, it's that frictionless aspect. You're not going through the clunky and expensive process of putting money, wiring money around, and it's supposed to be far more seamless. And this is what the digital renminbi, the digital dollar, what central bank digital currencies are supposed to be doing, like breaking down some of the frictions in the system. This is let's make no bones about it. This is disintermediating the banks and global payment system. So it's a delicate dance. The Chinese, there was a sense, when you look at the case of China, they just came out this week and punched Bitcoin right in the nose with a PBOC statement that Bitcoin is, by the way, everybody in China, not for purchasing things or pricing goods. That's not what we want. They've been, some people see their interest in promoting the digital renminbi as partially some of the motivation for them to squash Ant Financial and make them, play by the rules of traditional finance, so that the central government can do all of those whiz-bang payment stuff on their own, very controlled networks. The U.S. government is obviously not going down the same road in the same line of thinking, but it's something that really has to be considered. This is going to be a fascinating white paper, and where the Fed comes down on it, trying to make this balance between getting the advantages of a central bank digital currency without burning down parts of the global financial system or domestic financial system. This will be a fascinating process.
I'm looking forward to it. I can't wait. It is definitely an anticipated paper, and I'm not, as you can tell by my comments, not a big believer in crypto, but I do like the idea of of evolution in money by central bank authorities, and
especially cross-border. It's just very, very inefficient and very expensive, especially for the poorest of people. Remittance and things like that. We should be using this technology to level the playing field and cheapen that.
And that's where the Facebook and conglomerate digital currency they're talking about is to solve that very issue. A stable, trustworthy currency for poor people around the world is an interesting idea. And basically, the way they've done it is not this mysterious, Bitcoin kind of environment. It's pretty. It's open and transparent, and they've created something like, a central bank authority. To oversee it, which is kind of, which is interesting. And again, not sure that it's, if you've already got the Fed and you've got a digital currency, you can basically dollarize the world if you wanted to.
Yeah. Another reason that China is interested in digital currency is because every transaction on digital currency is put on a blockchain, so you can see what all your citizens are spending their money on. Which, if you're a totalitarian state, is a nice little thing to have in the back pocket.
I love that feature of it. Yeah. All right, guys. Next week, what do we got next week?
Very quiet week on the data front. The big one will be personal income and spending. And within that report, we get the PCE price index, which is the Fed's preferred inflation gauge.
We have a guest next week.
We do. We're going to be, as we've talked about the uncertainty over the growth outlook for the U.S. and how the recovery is really developing. We always have to wait for the monthly data. Well, not everybody does. The way that hedge funds and other institutions operate is they get some very almost real time data from groups like our friend. So her name is she's an old friend of ours. Her name is Anu Murgai, and she is an executive at Space No. They are a satellite-based company that monitors key economic activity in the U.S. and around the world. And we're really excited to get her insights and talk to her about how she does what she does.
Definitely. Wait, yeah, that should be really fascinating and a good show to look forward to. All right, guys, have a terrific weekend. We'll see you next week on the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.